Good evening, everybody. Hear me, Mike?
We got you, Jared.
Awesome. Great to see everybody tonight. That summer weather is slowly dwindling away, so I hope everybody enjoyed some of that 80-degree November weather. Well, we're really happy you guys are all joining us as always. We really have a great presentation. It's pretty wild that we're entering the fourth quarter because it's really been a terrific year. So I just want to thank all of you for joining us tonight. Thank you for the relationship, allowing us to be the ones in your life to help you have confidence that you're on track to your long-term goals. Encourage you to take those vacations, help you buy the vacation house or, any big life decisions. That's one of the most rewarding part of our job is really helping you guys. And also besides helping with those big decisions, just really being able to get to know you and celebrate all the wins, hearing about the trips, and of course being there for you through all the tough times also. So we just thank you for your trusted relationship with us. We're also really excited about next year. If you guys can believe it, next year we're celebrating our 30th anniversary. What I really want to have part of this celebration is a picture because my dad started this practice out of the basement of our townhouse. So many of you come to Lansdale or come to Conshohocken. We have this big office with all these people. It all started with my dad saying, you know what, I want to get out of the insurance business and focus on financial planning and really helping people make smart financial choices. And 30 years later, almost 800 clients. And I think 30 years attests to the advice that we've given to help people stay on track to their goals and most importantly, make those adjustments along the way. And I can confidently tell you we plan to do that for the next 30 years. And ideally, continuously look for ways to make your service and experience better. So I just want to thank all of you for relationships. Also, I want to thank all of you for the introductions. As you guys know, we're constantly looking to grow our business. We have amazing relationships, we're amazing clients. So as always, if you do have people who benefit from the financial planning experience you receive, I promise you they'll get the identical service and experience. So without further ado, I'm going to hand it over to Carolyn Cho, who is going to help introduce the speakers. Carolyn?
Can you hear me?
Yep.
Okay, great. Well, welcome and thank you to our speaker, Stephen Gilbert, and our advisors who are on the call and staff who helped make this meeting happen in this important seminar on tax planning. We believe in comprehensive financial planning, and we partner with you every step of the way. And that's what we always tell you. But what exactly is comprehensive financial planning? What does it really mean? And I was sharing this thought with my good friend and client, Monique, today. And she said, well, why don't you unpack this by just sharing a day in your life? She's a good friend of mine, so she knows what a day in my life is like. So I thought I'd just take 60 seconds to share what a day in the life today was. So I started the day congratulating one of my youngest clients on accepting his first job as a chemical engineer in the state of Washington. So congratulations, Ryan. I think his parents might be on the call, and they're very proud. Then I was in a meeting, and I had helped with the 529 before he went off to Villanova, and now he's a chemical engineer. Then I was in a meeting with a client's POA, followed that up with that's a power attorney, to help the POA sort out my client's needs because my client is seriously ill in a hospital. So that was a total change. And this was followed by a call to a client to follow up on her son's coming of age of majority. He just turned 18 and therefore able to manage his funds from an inheritance. So we'll be managing that. And this was followed by celebrating our CEO and founder who is on the call here, Harry Calla's birthday. So happy birthday, Harry. So today's a red letter day. And after that, I worked on a note with one of our extraordinary client service advisors, Paige Toten, whom some of you know, on crafting a note to a client to explain their living benefit on their variable annuity. That was followed lastly. I spent a wonderful 2 hours with another longtime client who's also on this call, completing her annual review, discussing not only her portfolio performance, which many of you do with our advisors, but how she can significantly reduce her taxes with a donor advised fund next year from her RMDs, her required minimum distribution. So that's a big part of what we are talking about tonight also on tax planning and tax saving strategies. And the icing of on the cake is then, of course, I get to join you tonight to introduce Stephen Gilbert as our marquee speaker. So this just gives you a sort of bird's eye view on a sliver of what that comprehensive financial planning is and all the different aspects of what financial planners do. And that's just one day. So that's what, and one advisor. So I'm sure all my colleagues are doing many interesting, exciting things in this one day. But without further ado, let me first give you an overview of Stephen Gilbert. He has got so many letters after his name. It's intimidating. He's a CFP, CLU, CHFC, CSL, and CRPC, which just means that he is very, very well versed in the areas of advanced planning and tax planning. Steve possesses a broad depth of experience that comes from almost 30 years in the financial services industry. He is part of Prudential Annuities Advanced Planning Solutions. He works extensively with financial professionals such as ourselves, aiding in complex opportunities of retirement planning, income distribution, and estate planning. He's a frequent speaker and published author on this subject, which is why we have invited him to share his expertise with us. He is a man after Harry's heart. They're both Penn State graduates, and he holds his FINRA series, of course, as well. So, and he's a member of the Financial Planning Association. So, without further ado, Stephen, please take the floor.
Great. Thank you, Carolyn. I think I'm about to blush there. So really appreciate that introduction. And good evening, everybody. Glad to spend a little bit of time here with you. And I do want to thank Harry, Jared, and Carolyn for that warm introduction. I want you to know, and I'm guessing that you probably are aware, that when you work with a quality firm like FIP, you're working with a firm that has a ton of resources they can deploy for your benefit. We're just one small insurance company they work with called Prudential. And I just hail from one small group within that firm, Prudential. And that's the Advanced Planning Group. We're a bank of attorneys, CPAs, and CFPs, and we're a dedicated resource to advisors such as the advisors at FIP. So just understand they have a ton of resources at their disposal. And we help them when it comes to gift and estate tax planning, income tax planning, a lot of Social Security, healthcare planning and retirement, trust cases. So just know there's a ton of resources there. But particularly tonight, we're going to talk about managing taxation in our overall planning. And this is a topic that I think not enough people really take serious enough. And when we think about planning and maybe even retirement income planning, we often talk about the biggest expenses that might need to be taken care of in retirement. But often in that conversation, what is missed is that for a lot of our clients, one of their largest expenses in retirement indeed will be taxes. And it should be treated as such and planned for as such. And the bottom line is sometimes the best planning we can do when it comes to taxation is to make sure that we're working with professionals that understand what the tax landscape looks like today, have a good idea of what it might look like tomorrow, so that you can devise strategies to make sure that we're successful and that one of our largest expenses in retirement are managed for. So tonight we're going to talk a little bit about the potential risk of higher taxes. Now we are post-election, so the picture has become a little bit clearer. And thankfully, some of the more draconian tax concerns we had are no longer realistic, but we'll talk a little bit about that. More importantly, we'll talk about some tax planning strategies to prepare for a better tax result, and then talk a little bit about tax efficient investing. But I think one of the things that we need to consider is the direction that we're headed. It may not feel like it, but we are in an environment where taxation from a historical perspective is fairly low. And where do we head from here? And I think there's a lot of things we should consider. I think one of the things that we should consider is this nation's capacity to potentially forego tax revenue or not. And the bottom line, I don't mean to start on a negative note, but this country is not in good physical shape. The bottom line is this country is well over $35 trillion in debt, quickly approaching 36 trillion. And that's a number that, maybe gives a few people a moment of pause, but probably more impactful is where we are from a debt to GDP ratio. And I'm sorry to tell you, this country is well over 120% debt to GDP ratio. And I think that's part of the formulation of where are we headed in the future when it comes to taxes, and can this country really forego tax revenue by providing tax cuts to the American public? And that has to be done in the backdrop of the reality of the physical condition of this country. Not only do we need to consider the condition of the country from its physical perspective, but we need to know what our legislators are proposing when it comes to taxes. Now, I'm not going to spend a lot of time on this slide for very good reason. We know the current administration is headed out the door. So it's good to know like where their headspace is in case all this stuff comes back someday. But in reality, the current administration is headed out the door. We know the Senate was already taken by the Republicans, and the House is one seat away from the Republicans gaining majority there. So these things are things that are back burner now. This could have been realistic, but as a result of the election, we don't necessarily have to worry about what the current administration's proposals are. And they had proposed things like increasing tax rates on a lot of our clients, clients that have a little bit higher levels of income, taxing them as high as 39.6, increasing investment taxation. We won't get too deep into it, but when it comes to investment taxation, we don't only pay our base tax, but if we have higher levels of income, we start paying something called a 3.8% Medicare surtax on net investment income. That wasn't good enough. They wanted to increase it to 5%. Again, these are things we no longer have to worry about. We'll talk a little bit about Roth today, and sometimes we make too much money to contribute to a Roth IRA, but we could still create a position in a Roth IRA through conversions. And there were proposals to limit that, to not even allow conversions to higher income Americans. Or God forbid, tax qualified dividends and long-term capital gains, which normally get favorable treatment, to tax them as ordinary income for some taxpayers. Or proposals to tax people on unrealized gain, not even selling the security and getting taxed on it. Or taxing gifts, which is not how the gifts tax system has ever worked, but creating a situation where taxes will be paid on a gift, say from one family member to another. Now, these are all things that we should put away in the back of our minds in case the folks that are involved in the current administration ever get back into power. But in reality, because we know the results of the election, we don't necessarily have to worry about these proposals, at least not yet. Now, probably what's more important is to understand what the new incoming administration would look like. And this is very easy stuff because the tax system that we live under today is called the Tax Cut and Jobs Act. And that came in under the new administration the last time they were in office. And they would like to keep it. They'd like to keep it right the way it is, meaning they wouldn't want to see increases in those tax brackets or see long-term capital gains or qualified dividends taxed unfavorably as ordinary income, or tax folks on gains that aren't realized, or increase the investment tax from 3.8 to 5, or try to take away Roth opportunities for individuals, or they would like to keep gifts the way they are, where we can gift to individuals and not have to worry about the gift being taxable, and keeping things like step up and basis at death, which relieves tax burden at our ultimate demise. So it's a more positive picture when it comes to what our future taxes will look like, at least maybe for the next 4 years. Now, that doesn't mean that'll necessarily happen. Why is that? Well, the bottom line is the current tax system, like I said, called the Tax Cut and Jobs Act, was built as temporary tax law. I'm not going to bore you with the details, but it was passed under a process called reconciliation. Now, that process allowed this tax legislation to be fast-tracked, but the downside of it is that it had an expiration date. The expiration date of the current Tax Cut and Jobs Act is the end of next year. If we don't see any legislation passed, we will see the current tax system disappear at the end of next year, and we'll slip into the tax system as it existed prior to that. What that means is for a lot of Americans, they'll creep into higher tax brackets. They'll see that the amount that's not taxable, their deductions, drop significantly. And from a totally different tax system, the transfer tax system, the estate and gift tax system, they'll see the exemption drop in half. Now, I'm not suggesting all Americans all of a sudden to be subject to a gift and estate tax on top of the income tax system, but many, many more Americans will, and it should be planned for. Now, a couple of things that we should kind of hone in when it comes to our personal taxes, or work with someone to hone on this, is we should know where we sit within the income tax system. We should take the time or work with someone to take the time to look at our own tax returns, determine where we are when it comes to taxable income, because it's important to know where we sit in our tax brackets for a lot of reasons. And if you take a look at the screen here, this is just showing you, if you take a focus on the right-hand side, what the tax brackets look like in this country in 2024. And knowing where we are in those brackets is important, because sometimes the best strategies that we can deploy are the strategies that leverage the tax bracket we have currently without skipping into the next. And one of the ways to leverage proper tax bracket management is to think about Roth conversions. I mean, if we think about the physical condition of this country not being in that great of shape, thinking about the sunsetting that's likely to occur in 2026, it's very easy to potentially draw the conclusion that our future tax system may be a tax system that taxes us at a higher rate. So the question is, if I have money in, say, a retirement account, I don't have control over whether that's taxable or not. If I'm in maybe a pre-tax portion of my employer plan, or I'm in a traditional IRA where I got a deduction, I don't have control over whether that dollar is taxable. It is 100% as ordinary income. I don't have control over that. But what we do have control over, and way too few people take advantage of it, is I have complete control over in which year it's distributed. Meaning, if I believe that I'm in a lower tax system now than what I will be in the future, then I can move that tax dollar to today's world, keeping it from being taxed in the future world through the power of Roth conversions. But I should do it in an intelligent fashion where I'm managing my current tax bracket, bringing just enough conversion to maybe just fill my current tax bracket without skipping into the next one. So, accelerating income, filling those brackets could make a ton of sense and a big difference. Now, like I said, not everything is taxed at those ordinary income tax rates. There are tax items that are taxed more favorably. We call it the long-term capital gains, the qualified dividends. Those aren't taxed at ordinary income rates. They're taxed at the rates that you're looking at here. And if you focus on the right-hand side, focus on the current year, what you'll notice, and maybe look at the joint at the bottom, so the bottom right-hand corner, most of the clients we work with are married. You can see the capital gains rate for many people is likely to be 15%. And I find a lot of people shorthand that, oh yeah, long-term capital gains 15%. No, that's not really true. 15% is the right answer for a large swath of folks in a certain income range, namely about $94,000 of taxable income to about $250,000. But I want you to notice that there's a 0% cap gains rate, and no one really talks about it, but it exists. And then if we're over $250,000 of income, you're not really at a 15% rate, because that's when that 3.8% Medicare surtax on net investment income comes in that we talked about just a few moments ago. So if your income is over $250,000, you're not at a 15% rate. You're paying another 3.8, so you're at 18.8. And then obviously if you have very nice levels of income, joint over about 580, your base cap gains rate is 20%. You're certainly paying a 3.8 at that point. So your rate is 23.8. But for those that are thinking about the future, thinking about retirement, I do want to draw to your attention the 0% cap gains rate. No, I get it. It's that's a low number. To fit in that $94,000 taxable income, that's a lower number. And we might not fit in there that easily. But what I would say is this is taxable income, and that's after deductions. And even for a married couple filing jointly, you add the standard deduction to that, you're talking over $120,000 of income. And I know that's pretty low for married couples filing joint. But I tell you, as you start to model out the future and look into retirement, and when wage income drops off the tax return, and what's hitting the tax return for income purposes is a Social Security check, a pension check if you're lucky these days, and some investment income. We oftentimes have folks that are retired that do slip into that 0% capital gain rate, which means they can release capital gain, appreciated assets, a capital gain at a 0% rate. And I really can't think of a better rate than 0%. And as we approach year end, one of the things that we should consider when it comes to our portfolio, and maybe, I know it's been pretty good, so probably not a lot of losses out there, but looking at the portfolio and looking at the losses and looking at the gains and seeing if there's some opportunity to offset some of the losses against some of the gain, or something that we would, shorthand to the terminology of tax loss harvesting. Now, like I said, we do have a standard deduction. And look, right now in today's world, 90% of Americans do not itemize their tax deductions. In today's world, about 90% of Americans take the standard deduction, means that they can't itemize if they take the standard. And that makes sense. I mean, look at the number. For married filing jointly, the standard deduction is over $29,000. It wouldn't make sense to itemize until you found over $29,000 of itemized deductions. And what it turns out is 90% of Americans can't get that to work. Or another way to say it is only about 10% of Americans actually itemize their deductions. But like I said, the sunsetting is set to occur at the end of next year. And if it does occur, if legislation isn't passed, we'll see this standard deduction drop from about 29,000 all the way down to barely over 16,000. And what will happen at that time is a lot of folks will say, well, that standard deduction is a heck of a lot lower. Now, when I look at my itemized deductions, maybe they do exceed this $16,000 figure, and I'm going to start itemizing. Now, there are some things that, we should consider while we have this standard deduction of 29,000. And one of them is the idea of a qualified charitable distribution, which we'll spend a little bit of time on a little bit later. But look, the bottom line is if 90% of Americans are taking the standard deduction, they can give to charity all they want, and they do, but they're not going to get a tax break from it. The way our tax system works, you either itemize your deductions or you take the standard. You don't get to do both. And if you take the standard deduction, you can't itemize your charitable deductions. So 90% of Americans, because they take the standard, they can give the charity all they want, but it's not providing them a tax benefit. However, at least for folks that are a little bit older, defined as 70 and a half or older, all they have to do is change the mechanics in which they make the gift to get a break back. And the bottom line is if you're over 70 and a half, you can have a distribution come straight from your IRA to the charity of your choice. And what's the net result? The distribution from the IRA, which is normally 100% taxable as ordinary income, isn't taxable at all. And it'll satisfy any required distributions that you might have as an RMD. So again, we're not saying, hey, give to a different charity, give a different amount. We're saying just change the mechanics in which you make that gift so that we can get you a tax benefit. Another thing to think about is a process called deduction bunching. Now, this might not be the year for deduction bunching, but I think we're going to see a lot of it next year. And the idea is, I promise you that people have sat down with their taxes and did everything they could to make sure they don't pay more than they need to. And they may have sat down and went through all the receipts and look at all their itemized deductions. And they might have found that their itemized deductions were 27, 28,000, a lot of itemized deductions. But what are they going to do? They're going to take the $27,000 or $28,000 of itemized deductions, or they can take the $29,000 of standard deduction. They're going to want the most that they deduct, the largest deduction they can. They're not going to pay more taxes on principal. But the problem is, if you're going to take that standard deduction and you know that your itemized deductions were darn close, how does that feel to take that weekend's worth of work going through receipts and then in the end take the standard deduction like the other 90% of Americans? It doesn't feel great. So maybe the idea is, well, maybe I try to get the best of both worlds. And this could work particularly good in 2025. Maybe what I do in 2025 is try to push some of my itemized deductions off of the 2025 slate and onto the 2026 slate so that I can really leverage the itemized deductions when that standard deduction potentially drops to 16 grand. So a couple things to think about when it comes to that standard deduction. Now, look, I'm sorry to tell you, but there's more than one tax system. There's a heck of a lot more than one tax system in this country. We tend to talk about the income tax system because it's the one that we wrestle with on a day in, day out basis. But there is another important tax system that we need to pay attention to. And that's what you might call the transfer tax system or the gift and estate tax system. And understand, this isn't a lieu of income tax. This is just another tax. And the bottom line is very few Americans today are subject to a legitimate federal gift and estate tax issue. Why? Because there's a huge exemption. Right now, the current unified gift and estate tax exemption is over $13.6 million, which means I can take a check right now, stroke it for $13.61 million, hand it to my neighbor, and I wouldn't have a gift tax because it's covered under the exemption. Now, check will bounce, of course. Or to kind of change the picture, let's say I didn't give that check away, but I died, and my estate was worth less than $13.61 million. I wouldn't have an estate tax. It's not until I'm over the exemption that I would have this problem. And that estate tax, the problem is it's a loss of 40% to the government. Now, again, we're not promised to keep this 13.61. Now, we already have the 2025 numbers. It's just a scooch under 14 million. But again, with the sunsetting of Tax Cut and Jobs Act, if it occurs as is, that exemption will drop to about 7 million in 2026. And again, I'm not saying everybody all of a sudden becomes subject to a gift and estate tax. That's not true. But a lot more Americans will when the exemption drops to about $7 million. And the point here is, if we're in that range, where we're even after the sunsetting, we have a legitimate gift and estate tax issue. We have a very unique opportunity for the remainder of this year, which is what, a month and a half, and then the 12 months of 2025, to do planning that we might not ever be able to do again. To be able to leverage this size of an exemption before it disappears, so that we could stave off losing 40% to the government and allow our family to keep a larger portion of our assets. Now, that's the annual exclusion, excuse me, that's the lifetime exemption amount. The annual exclusion gift is in addition to Like I can give 13.61 million now under the lifetime exemption, but I still have an additional opportunity to make annual exclusion gifts. And the way the system works now, I can strike a check for 18 grand. I can give it to everyone on this meeting here today, and I would not have a gift tax. Not only would I not have a gift tax, I wouldn't even have to report those gifts. That's the power of an annual gift, is I can give 18 grand to as many people. I could have 10 kids and grandkids. That's 180,000 I can give away. And not only is it not a taxable gift, I don't even have to report it because it falls under the annual exclusion amount. And for folks that, have a legitimate gift and estate tax issue, if you do it right and you leverage the strategies to make sure you're maximizing your unified exemption, the 13.61 or 13.9 next year, and maximize your annual exclusion gifts, and then add in a couple charitable concepts, really at the end of the day, estate taxes are an option, right? With the right type of planning, it's optional whether you pay estate taxes or not, depending upon the type of planning you do. Now, when it comes to tax efficient investing, we need to be careful with how we're investing our dollars. We need to be concerned with what kind of turnover is occurring in the investments that I have. Maybe I should be focusing more on the after-tax returns rather than the heavily published pre-tax returns. Maybe I should consider the holding time of investments as a long-term investment, as a short-term investment, and should I leverage, if it is long-term, assets that might provide a tax deferral opportunity. I should entertain the idea of the cost of rebalancing. Like normally when we have a portfolio that we want to hold to, we want to make sure it doesn't get too far away from our desired allocations. And that might bring in the concept of rebalancing, which by definition, although a sound investment strategy, might yield some tax consequences. So is there an efficient way of doing that? And then we should be watching items like making sure our tax cost ratios are in line and that we don't have excess tax drag. One of the ways to manage tax when appropriate for longer term goals is considering investments that might offer tax deferral, giving us control back over the taxation that we occur in those tax deferred assets. Call it, retirement plans, IRAs, deferred annuities. This gives us control. It allows us to do tax bracket management, meaning I have, in a tax deferred investment, I have control over whether a tax item ends up on my 1040 or not. I have control not only of whether it happens, but I have control over it to the penny how much is recognized on my tax return, which means, again, I could do that effective use of tax bracket management. I can rebalance all I want. I can rebalance all I want on my 401k, my IRA, my deferred annuity, and it's not going to create a tax event. Would in my taxable account, but not in my tax deferred account. And then sometimes we can leverage tax deferral very tactically to potentially reduce Social Security tax or maybe stave off higher Medicare premiums. And when it comes to leveraging tax deferral, we should be smart about what we might call asset location. Because some of the investments that we will want to be in are already tax efficient. And if they're already tax efficient, why would you need tax deferral? So if you're in assets where, say you're in stock long, that's long-term capital gains. That's favorable. You're in a fund where the manager has a mandate to manage tax. It better be tax efficient. Things like ETFs, index funds, they're pretty tax efficient. A low turnover fund, a muni holding. These are all tax efficient. No one should be arguing that these types of already tax efficient assets need tax deferral. But a lot of times, folks aren't comfortable just having those assets. Maybe they don't want the tax tail to wag the dog. Maybe they want a fund manager that's going to actively manage, maybe sell securities, under a short-term regime instead of a long-term regime. And in that case, likely to kick off short-term capital gains, which are just taxed as ordinary income. Now, they'll get that favorable treatment. Fixed income looks a lot more attractive than it once did. So maybe I want to mix in a little bit of fixed income to the portfolio. Well, that's taxed as ordinary income. Maybe I want a little bit more in the way of alternatives in REITs. Generally not that tax efficient. So maybe what I do is I take the assets that I want that might not be that efficient and leverage those in a tax deferral opportunity. And as we start to, close out the year, some other things that we might want to consider is, have we maxed out our opportunities? A lot of us might have a 401k. Have you, if you can, have you maxed out the opportunity? And for the typical participant in a 401k, but it'd also be true of a 403b or a governmental 457b. If you're not 50, you can put as much as 23,000 in the plan. So have you done that? And look, not everybody can do that, but have you done as much as you can to make sure you put away as much as you can for your future success in retirement? And then if you're over 50, you can actually put more into those employer plans. You can put another 7,500 if you're over 50. That gets you about 30,500. Now, with an employer plan, you only have 6 weeks essentially to try to max out these plans. So you kind of a limited opportunity to try to do your best to max out your employer plans. Now, when it comes to the 401ks and the 403bs and the governmental 457bs and all these retirement plans, there is an overall plan cap, which this year is around 69,000. And the only reason I bring that up is, this $23,000 limit we talk about, that is a limit to how much we can put in either to our pre-tax account in our 401k or our designated Roth account in our 401k. We can put any mix we want between pre-tax and Roth, as long as we don't exceed the 23,000 if we're under 50. But a significant amount of particularly 401k plans allow more than just a pre-tax option and a Roth option, but they make a third option available, which is voluntary after-tax contributions. And the importance with the voluntary after-tax contributions is they are not held to the $23,000 limit, which means for a lot of people that we help kind of take a look at this idea, there may be another 25, 30,000 they can put in the plan that no one ever really tells them about in the way of an after-tax contribution. And the beauty of the after-tax contribution is not just that you can put more in the plan than anybody's really telling you, but that the IRS clarified that, several years ago, that when you pull that after-tax dollar out, when you're ready and able to pull that after-tax dollar out, that you can convert it to a Roth IRA completely tax-free. It's a heck of an opportunity that a lot of people miss. Are we maxing out what we can do in the IRA space? Whether it's a traditional IRA or whether it's a Roth IRA. Right now, the most we could contribute to an IRA is $7,000. If we're over 50, you can put another $1,000. So you can put $8,000 in. Sure, you have until the tax filing deadline to do it, but why wait to the last minute? Have you take a look and make sure that you maxed out what you can do in the IRA world. Now, there's some limitations, and maybe make sure you sit down with the advisor and discuss your situation, see if you can even do it, but have you looked into it? And then, a lot more Americans are being, their employers are putting them on these healthcare plans that have, higher deductibles, putting more and more responsibility on the individual participant in the plan. And if that's the case, if we have one of these high deductible plans, which, by the government's definition would be about a $1,600 deductible for an individual or $3,200 deductible for kind of family coverage, then you're able to leverage something called a health savings account, which I think way too few people take the advantage of. And it feels a little bit like an IRA because there's contribution limits, but for a family coverage person, You can put over 8 grand in the health savings account for like a single type person. You put a little over 4 grand in the health savings account. And the benefits of contributing to the health savings account is it lowers your taxes today while the money sits inside the health savings account. It grows tax free. And then when it comes down to paying a healthcare bill, so it has to be used for healthcare expenses, it comes out tax free. Yeah, you heard it. A tax break up front, a tax deduction up front, stays in the account, grows tax free, and then when used for healthcare somewhere in the future, comes out tax free. That's a nice tax treatment of that kind of asset. And then as we start to close up here, particularly at year end, we got a month and a half. For those of us that might be a little bit older, don't forget you have an RMD that would be due by the end of the year. And a lot of folks get very upset about these RMDs, and really the vast majority of Americans kind of just sign up for the government prescribed plan. And generally right now, for someone that attains age 73, that's when their RMDs start. And I can't tell you how many times we sit down with clients and they're like, "No one ever told me about this. I don't want this money coming out of my IRA. I don't need this money coming out of my IRA. If it was my druthers, I wouldn't have distributed this from my IRA." But it's not a choice. That's why it's called a required minimum distribution. The government eventually gets tired of not getting their tax revenue. And that starts these days, it's been moving around, but it's these days around age 73. And the government says, well, we're not going to let you defer anymore. You got to take distributions out of this account. And then what happens is every year you get older, they ask for a larger and larger percentage of your account to be distributed. And a lot of times, and look, I know times are changing. A lot of times, one of a couple will have a lot more IRA and retirement dollars than the other. These distributions are based upon the IRA holder's life expectancy. And, if you're in a situation where you have these ever increasing percentage distributions, running God forbid, a bad market cycle, that surviving spouse might be in a bad position. So there are ways of protecting that. There are institutions that'll say, well, not really concerned how high that RMD gets or how long you live or what market conditions. We'll always make sure that there's income for the surviving spouse. Or there's institutions that'll say, okay, yeah, we get it. If there's a bad cycle of returns, this could be extremely damaging. Call it sequence of return risk. Maybe we can mitigate this by providing some downside protection in markets. Now, like I said, RMDs have been moving around. Like we don't really care about 7.5 or 72 anymore. Most people, their RMDs are going to start at 73 these days. Now, if you're born 1960 or later, your RMD actually doesn't start until age 75. So a little bit of a moving target. But as the year approaches, ending in just a month and a half, particularly if you're in this age range, make sure you're sitting down, talk with your advisors about those RMDs and about ways of managing those RMDs. Because I find way too often people don't plan for their RMDs. They get surprised by them when they're in their 70s. And because they haven't done the planning, are unhappy with the results. And one way to think about managing RMDs is the qualified charitable distribution that I talked about a little bit earlier. And remember what I said about qualified charitable distributions. Look, you got to be 7.5 to do it. But, particularly if you're in the 90% of Americans that are taking a standard deduction, but you're still a good person, you still give the charity, but you don't get a tax break because you take the standard deduction like 90% of Americans do, at least if we're 7.5, maybe we can change the mechanics of the gift. Instead of striking the check out of the checkbook and not getting a tax break, maybe ask to have the distribution sent from your IRA, have what would otherwise be taxed as 100% ordinary income, not taxed at all, and have it satisfy your required minimum distribution. So I I thank you for taking the time to kind of look at some of these ideas. Hopefully, some of them might have resonated with you. Hopefully, if so, you sit down with your advisor, you have the conversation. And again, I think way too few people take this conversation serious enough, right? They'll want to talk about healthcare costs and housing costs in retirement, and way too many people completely ignore that one of their largest expenses in retirement will be taxes, and we should know that, and we should treat it as such. So again, thank you for your time. Definitely appreciate it. Carolyn, I see you ready to go, so I'm gonna turn it over to you. I'm not sure if any questions came through, but always glad to take those.
Yeah, thank you so much. Bit of an information overload here. Well, your slides, I guess, will be available, Steve.
Yeah, I think I've sent them a little bit earlier, so I'm sure they'll distribute them.
That's great. And Mike, I think he had taken in some of the questions. Mike, do you have the questions?
I did get some questions. Let me pull them up here. All right. So here's one, Steve. You mentioned Roth conversions. What are some of the reasons one might do a conversion, and what are some reasons one might not do a conversion?
Yeah, fair question. There are several reasons why someone might consider a Roth conversion. One of them might be that they are of the opinion that taxes will be higher in the future than what they are today. So that would argue a conversion because you're pulling the taxable consequence into a lower tax environment instead of a higher tax environment. So that might be one. You're concerned about future higher tax rates. You're going to take advantage of today's lower tax system. Another reason folks might look at Roth conversions is a little bit of what I was getting at the end. Because I can't tell you how many times I run into folks who I guess were just totally shocked about RMDs. They get in their 70s, the RMD starts, they're mad no one ever told them about these things. They're mad the government's making them take income out of the IRA that should not be their choice. And a lot of times, because there was no planning done, they end up having more taxable consequences than they really should. And a lot of times, they might even skip into higher tax brackets. Well, those required minimum distributions are required out of traditional IRAs, but they are not required out of Roth IRAs. So if I had just done the planning, right? If I just had considered a managed Roth conversions throughout the years, could I have replaced my traditional IRA dollars with more Roth dollars? The answer is yeah, with the right planning. And as a result, what you would have been doing in the same process is lowering what your future RMDs would look like. So it's a concern about future tax rates. It's trying to manage this RMD issue that far few people manage. And then, I'm not going to get deep into the Secure Act because we've been talking a lot about that over the last couple of years. But the bottom line is that as a result of those law changes, our healthy adult kids, they used to be able to take our retirement dollars and IRAs and stretch over their entire lifetimes. And that's been stripped away from them. They can no longer do that. And instead, what the government has replaced it with is a massive acceleration of that recognition of income. And those healthy adult kids now have to recognize all the income within a 10-year period. Maybe one way to consider it is, let's say I leave, whatever, $1 million IRA to my kid. It used to be I could stretch over the whole life, spread the taxes out, and it all would be, fine and off. But in today's world, if I leave $1 million IRA to my healthy adult kid, they have to distribute that in 10 years. That's a lot of income being recognized in each one of those 10 years. And I think another thing the government figured out is like when we die, let's just say we die in our 80s or 90s, our kids will be in the highest earning years of their lives. Meaning they'll be in the years of their lives where they're paying more in the way of taxation than they have at any other point in their life. And now here comes this massive acceleration of income into a short 10-year period. But if I had just done a little bit of planning, and maybe if I figured out a way to leave more Roth IRA dollars to the kids and less traditional IRAs to the kids, those Roth dollars they'll go tax-free to the heirs. In order to get a Roth IRA to be tax-free, you only really need two things. 5-year period in the Roth IRA, and then a triggering event, and death is one of them. So those are some of the reasons that we see our clients gravitating to doing conversions. Now, does that mean everybody should do a conversion? God, no. Absolutely not. Some reasons not to do a conversion. Although I could tell you that, most likely we'll see some form of the sunsetting occur. And do I think that the tax regime in 2026 will probably be higher than today? Yes. Can I tell you to the degree? No, we don't even know the result of the House election yet, but it does look like it's going to the Republicans. But the bottom line is that doesn't mean that the individual couple will be in higher tax rates. Just because as the system has a higher tax rate, that doesn't mean the individual does. Because some individuals do the planning, and I've seen it, where you'll have individuals who are wealthy, who are worth millions of dollars, and yet somehow have done the right kind of planning and actually are not in high tax brackets when they're in retirement. Why? Because they did the planning. They had a big portion of Roth dollars and not a whole lot of traditional IRA dollars. They have health savings accounts that are large enough to supply all the income they need to cover healthcare and retirement. They've maybe looked at some life insurance concepts to generate tax-free income in retirement. And to be honest, the ones that I've seen do this successful, yeah, they live kind of frugally, right? Even though they're worth millions, you can't tell because they live, like the Joneses next door, right? But with the right planning, maybe you won't be in the higher tax bracket. Well, if you as an individual don't model out to be in a higher tax bracket in retirement, then that conversion makes a lot less sense. It also is more powerful the younger you are. And I think that, intuitively makes sense. If I create a tax-free situation sooner and get more tax-free growth because I did it earlier, that's more powerful. So conversions, those should be entertained, earlier in life, as early as it makes sense for the individual. And then the more I wait, the less powerful that conversion becomes. Now, what I don't mean to say is that eventually we just get too old that conversions don't make sense anymore. That's not true. But as we age, we got to be a lot more careful with how we do the conversion process. So, there's a balance, and it's about knowing the individual, and that's where a professional comes in.
Sure, sure. So you touched on this a little bit in your explanation about you have some questions about RMDs. What can we do to plan for an RMD?
Yeah, I guess you're right. I kind of covered part of that, right? If I'm trying to manage what my future RMDs are, if I'm trying to stave off an onslaught of income in my 70s, then probably one of the best strategies, if reasonable given my planning, is to reduce the dollars that are subject to RMD. So reduce traditional IRA type balances and increase the portion that's tax free and not subject to RMDs like the Roth. Qualified charitable distributions that we kind of mentioned towards the end would also be a powerful RMD management technique. Because look, if I'm already giving to charity and now I got to take this RMD out, look, I'm not saying give to a different charity or give a different amount. I'm just saying being smart about how you do the gift, give it out of the IRA. You're not giving any more to any different charity. You're just being smarter about the mechanics of it by executing a qualified charitable distribution, and in that way taking what otherwise would be taxable income and making it non-taxable. So those are a couple different strategies to consider.
Sure. So one last question I'm going to put to you from the questions I've got ahead of time, and then we'll open up the floor. You had mentioned that some more folks are going to be subject to estate taxes in 2026. What are some things that we could do to prepare?
Yeah, and it goes a little bit of what I was talking about on that estate tax slide, and that is making sure that if we have these types of issues, that we're building an intelligent plan on how to leverage our lifetime exemption. So like I said, the lifetime exemption right now this year is 13.61. Next year it grows a little bit more. It's just under 14 million. And then it's slated to drop to about 7 million in 2026. So really, the biggest advantage, the most powerful advantage, and really unique, I've been doing this stuff 30 years, really unique opportunity for the right person is to be able to leverage that exemption, between now and the end of 2025 before it drops in 2026. And then also it's not just a lifetime exemption, but using those annual exclusion gifts. Like literally, I give it, we can give 18 grand to as many people as we want. Not only is that not a taxable gift, it's not even reportable. So a combination of those two, and then after that, sitting down with someone and talking about some of the more unique charitable gifting strategies could go a long way and really, essentially make paying an estate tax an optional situation.
Sure, sure. So I think we have one or two other questions coming in. Mr. Friedman, I see you have your hand raised. Do you have a question?
Your audio is not on, Mr.
Hold on
Friedman.
a minute. Can you hear me now?
Yes,
We
sir.
can hear you.
Okay, well, I have a bunch of questions. The first one is, because I know other people have it, is there a way that if you and your wife both pass away, relative to the beneficiaries for the IRA, because they will probably be earning less, even though they will be making income, would it be wise for them to convert that to a Roth IRA then?
Well, that's part of the reason we need to do it while we're alive. A beneficiary is actually prohibited from converting an inherited account from traditional to Roth. So that's a unique opportunity available to
I'm
the
talking
tradition.
about, wait. So you're saying that even though it's an IRA, that they receive money in the IRA and money out of the IRA. So you're saying that even though it's in an IRA account, when you and your wife pass away, that cannot be converted to a Roth
After death, no.
after death.
After death. So let's just say
Oh,
it's the
okay.
kids or something like that. Those kids actually don't have the same power we do. While we're alive, we can do the conversion, at least for now. Like, no one's taking it away
So I
anytime
guess
soon.
then the question is, even though you say it, and you said that there is a limitation on the gift tax, but that nobody, it's obviously not something reported to the government. And again, we're talking, I assume that there are people who obviously are gifting more than 18,000 to, let's be honest, to their children because of that reason.
Yeah, I think you're mixing two different systems. You got the income tax system, which is really
Correct.
what we're worried about with the IRA, and then a separate, and I know it is complicated, a separate tax system that really has nothing to do with the income tax system, which is the gift and estate tax system.
Right.
So when it
Right.
comes to the gift and estate tax system, I have the 13.61 I can give away, but when it comes to the annual exclusion gift, I can give 18 grand. And like to clarify that, that's per person. So like if me and the wife want to both get together and make a gift to a grandchild, that's $36,000 that we can give away. And the importance of that annual exclusion gift is not only is it not taxable because it fits under the annual exclusion amount, it's not even reportable. I don't even have to do a
Right.
gift
Right.
tax
Correct.
return.
Right.
Now, of course, maybe I want to give 50 grand to my grandkid. That's fine. There's nothing wrong with doing that. 36,000 of it would fit under the annual exclusion gift. The remainder would be considered a lifetime exemption gift. But again, I can give $13.61 million dollars. So like, unless we're going to be worth, more than $7 million dollars in 2026. That's not really a problem because the lifetime exemption is so large. It's just now I got to do a report,
Right.
right? Because I'm
I
beyond.
know, I know that you have no control over the future, but now we have a Republican president, a
Mhm.
Republican Senate, and a Republican House. You know what's been said. You know that they have control. Your predictions for the next 4 years. That would help us.
Yeah, it's unfair, but I'll give I'll give it a shot. Um, what do I know with fairly good confidence? I don't have to worry about any of the current administration's proposals.
No,
I
forget
don't have
about
to worry
that.
about any of that, right?
Yeah.
So throw all that out. What am I left with? I'm left with what their druthers are, which is just a pure elimination of the sunset of the Tax Cut and Jobs Act. That's one end of the spectrum, I would say. The other end of the spectrum is just the sunsetting occurs as is. So where do I think we'll be? Somewhere in between. And everyone take this as my opinion, because that's all it really is. Not an educated opinion, but an opinion. We'll be somewhere in the middle. And I'm a little curious to see where in the middle we'll be. And what I mean by that, if you look at the last administration's income tax proposal, minus some of those draconian things I showed you, one of their big tenets was, oh, we will like to see the sunsetting occur, but not for everybody. We'd like to see
Mhm.
the sunsetting occur essentially for those that have income over 400,000, and we'll keep today's lower tax system for those that are under. Um, Now, I think we'll be in the middle. Will that be the middle ground? I don't know. I'm kind of curious. Maybe it will be, which will be a little bit funny because it'll essentially look like what the past administration was looking for. Anyways, I don't have a crystal ball. I don't know. Maybe you have information I don't have. We're still waiting for that one seat in the House, but it is pretty
I
much.
think it was announced that I think that it's now gone, I think, to the Republicans.
It could, because there were 17 votes when I opened up
That's
the
right.
webinar. They
Yeah.
could be at 18. I've just been talking to you
Yeah.
guys, so I don't know. So, but it's going to happen. I mean, we're pretty confident of it. So yeah, there's my answer. It'll be somewhere in between a complete sunset and no sunset, but we don't have to worry about any of the past administration's proposals.
Okay. Miss Shapey, I see you have your hand raised as well. Do you have a question?
Yes. Can you talk a little bit about these capital gains? Is that is that the money that's coming out of the IRAs?
Mm-mm.
Um,
No. So,
where's this? Where are these capital gains that are being
yep,
taxed at 0%? Because can middle
that's a good
class
tax rate,
people do
right?
this? Or is this just rich people?
No, it would be the
Those
opposite.
who
It
wanted the
would be
Republicans.
Yeah, it would be people. So I threw the slide back up just so that people would have a reference to what we're talking about. And let me just flip back and forth real quick. These are income tax rates. So like when we work, our wages are taxed at income tax rates. To your point, I take money out of my traditional IRA where I got deductions and all that. That's taxed at these ordinary income rates. And you can see it can be high as 37% depending upon where you are in income level.
Right.
But the bottom line is like the standard cap gain rate, again, it's not going to be for everybody. It was around 15. So that's a low rate if you look at this table, right? Now, these are the cap gain rates. Now, where do we get a cap gain rate from? In addition, it's not just cap gain rate, all that's what the slide says. Qualified dividends would also be taxed this way. And as you can see, the rates are much lower, right? I mean, if you look at 24 and you look at joint, because a lot of people are probably married, you're at a 15% rate, essentially up to about $250,000 of income. So that's a lot lower than what those ordinary income rates are. But I guess the important point is, how do I get it? Like what type of transaction would release a cap gain, a long-term cap gain, as opposed to ordinary income? And that's usually a capital transaction. I guess the easiest way to say it is you got stock or mutual fund, or you got some type of security, and you sell it for a gain. That would be a capital gain. And then like qualified dividends would fit in here too. So if you have a stock that's kicking off a dividend that is considered qualified, it would be taxed at these rates. And if you think about it, and maybe that's why no one talks about that. I'm always upset that no one ever really talks about this. And again, I'm not saying it's going to apply to the majority of the people on the phone, but when we retire, it may. And you can see the opposite. So if you look at 2024, look at joint, so look at the right bottom sheet, you can see the 0% rate is only applicable to 94,000. And when you get over that, then you start paying the 15%, which really isn't that bad. But 0% is like a really good rate.
Mhm.
But it's also important to understand what that 94,000 is. That 94,000 is what you call taxable income. So we're getting a little geeky and getting into tax forms, but just stay with me for a minute. That's taxable income, which isn't what we would normally think about our income. when we think about our income, we're thinking, oh, I got wages, and maybe I did take some money out of the IRA, and maybe I did have some capital gains or some dividends. That's kind of what we normally think of when we think about income. That's not what this number is. This number is after taking deductions. And if you kind of remember what we talked about, the standard deduction's around 29 grand. So if you just apply the standard deduction to this $94,000 figure, so add 29,000 to 94, you're talking about folks that make income like AGI type income under 123,000. Now it's not going to be a lot of married people, right? Yeah, when we're working and stuff, odds are we probably make as a couple more than 123,000. But my point is too many people do not discuss the fact that when we retire and we don't have wage income, and the income that's coming in is now a Social Security check and a pension check if we're lucky these days. I won't get a pension check. And then taxation from our investments, whether it be dividends or cap gains or whatever. It's very likely that a lot of our clients will be under the $123,000 of income or $94,000 of taxable income, and they can release a 0% cap gains. But what I find, and this is why I always bring it up, I find that no one ever talks about this. And and really the only other way to get rid of the cap gain taxation is to die. It's called step up in basis, right? And not to get too deep into that, but if I bought a 100,000 in Apple stock, and when I died it was worth $1 million. Like if I sold it the day before I died, I'd have $900,000 of capital gain recognition that I have to pay taxes on. The moment I die and it goes to my kids, the whole tax is wiped out. My basis gets pushed up to $1 million. It's worth $1 million. There's no gain there. There might be some future gain, but there's no gain there. That's a 0% rate. But what we're trying to say here, and again, not enough people talk about this, is we might have retirees that fit into the 0% cap gains rate, and no one's helping them take advantage of it, which is a shame. So that's kind of my point there.
When you say this, you said the selling of, let's say, a stock.
Yep.
Does that also include the reinvestment in that money that is in stocks or mutual funds that are not in your retirement account?
Correct. We're talking about not in your retirement account. Everything in your retirement account.
Correct.
Well, if it's traditional IRA that said that a deduction's been taken or pre-tax in your 401k, that's ordinary income type stuff. You're not
Correct.
going to get capital gain treatment. But, if you have an outside, just call it a stock portfolio or a managed money account or whatever it might be, that's not an IRA, that's not a 401k, that's not a deferred annuity. That is just, stock held, what we would call non-qualified, if that's a term you understand. That's when we see the opportunity for long-term capital gains is outside of those retirement type accounts. That makes sense?
Yes. I don't want to be asking too many questions, so if anybody else wants to, free to ask, but you talked about something that is very discerning for the future for anybody at any age group. That's the federal debt and what that's going to mean for the future. It is highly unlikely you would think that the Republicans will want to increase taxes. I mean, there's only two ways you can end up significantly reducing. It's either got to be an increase in taxes or a decrease in expenses.
Exactly
So
right.
taxes, I think, I would say I would be very surprised if there's significant tax increases the next 4 years. How do we lower the federal debt when we take a look at both the Democrats and the Republicans, whatever they were talking about would markedly increase the expenses for the future and increase our federal debt? And what does that mean to our investments?
Thank
All right.
you, Arnold.
Well,
That's a really good question.
it is one that I'm going to tap toe dance around because I'm not an economist. I'm a CFP, a tax planner, I'm all that. I'm not an economist, but I can give you some things to think about. You're absolutely right. It is, they want to make it sound like it's rocket science. It isn't. You either increase tax revenue or reduce spending, and that's pretty much it. They can tap down around it all they want, but that's kind of it. How do we get this debt down? I mean, you're asking me a question that our legislators haven't been able to figure out for a long time. But if we could truly cut down on expenses, on spending, then that would be helpful. Now, whether they have the wherewithal and the gall and get it through and all that, that's a whole different question. But if we can get spending under some type of control, that would be helpful. Um, and then taxes are the other side, and that's why I gave the answer I did earlier. Asking that crystal ball question, what does the future look like? And what I do know is we don't have to worry about the current administration's proposal anymore. And I know the two ends of the spectrum are either they get everything they want and the sunsetting occurs, or the sunsetting doesn't occur, or they get everything they don't want and the sunsetting occurs. The answer is somewhere in between there. And I think that answer is dependent upon what the heck Republican means anymore. I mean, it used to mean that you're kind of a physical conservative and that kind of thing. I don't really recognize it anymore. It's morphed into something a little bit different. But the bottom line is, even if we have, it looks like the Republicans do have the presidency, they do have the Senate. I show them still one vote away from the House, but they'll get it. That doesn't mean they just get what they want. And I guess a prime example of that is if you look at the tax system we're under now that they want to continue, the Tax Cut and Jobs Act, they weren't able to get that through Congress cleanly. They still, even though they had they had the trifecta then, they still had to go through a kind of a middle ground process called reconciliation. And at that point, it, by definition, became this temporary thing. Why is that? Because, essentially, if you're not at a 60% control of the Senate, then the other party has definitive control over whether legislation passes or not. And although the Senate has been won by the Republicans, they don't have a 60% advantage. So there'll still be some negotiations. So, and maybe negotiations are good. If it goes to the reconciliation process, then there is a lot of negotiation that needs to be done. And maybe that's a good thing. So we come somewhere in the middle because I don't think either extreme is the right answer. I think the right answer is probably somewhere in the middle. And how do we get there? You got to get people to the table, and maybe reconciliation does that.
I mean, again, the scary part of it is the fact that, my European friends pay more taxes than we do. So everybody who talks about maybe we should go over to Europe, I think things are still not as good as you think. In our country, we live a good life. That's all I can say.
I agree with you. Grass is always greener on that other side, isn't it?
And the other
we
thing,
also have to think of our kids and the grandkids,
hopefully,
right?
Absolutely.
Right.
That's correct.
Not just
That's
us.
correct.
You're
Yeah.
old.
And you're right. The other thing is that the other thing discouraging, if we wanted to go ahead and reduce expenses, the two things that are costing the most is the military when we're in the midst of supporting two wars. And the other aspect is that people are living longer, so the medical expenses keep on rising. So
Right.
this is the other thing.
Medicare and Social Security, huge.
And
Won't want them
Yep.
to take that away.
And that is the other issue for everybody, especially the next generation. Yeah. But something, we've done pretty well in the United States figuring out things. And I think hopefully that will continue in the future.
Do we have any other questions?
You were great.
thank you.
Okay. Well, I want to thank the vigorous participation. I think this is one of the most vigorous ones we've had from our audience, from emails that came in with questions that were given that Mike collated and from our audience today. In closing, I'd like to have our fearless CEO, Harry, give some final remarks. And of course, once again, wish him a happy birthday.
Oh, thanks, Carolyn and Jared and Mike for putting this all together, and Steve Gilbert for a wonderful presentation. Very thorough. Good answers to the questions. Arnold, thank you for your questions. Challenge the speaker. It was interesting because Jared and I are talking and saying, well, we should have one of our meetings as a tax planning meeting so our clients understand that we do tax planning. And I want our clients all to know that every meeting we do is a tax planning meeting. So that's why it's important that we do gather the tax returns, as soon as they're available. In the beginning of the year, we meet and we plan for the required distributions for the year. In the middle of the year, we're looking at the transactions and how they'll affect your income taxes and then your taxes on your Medicare, your IRMA limits. And then at the end of the year, we're looking for tax loss harvesting and ideas to keep your tax brackets low, and then for ideas to look at opportunities for Roth conversions. And I really think it was great that you identified that if we had an estate problem, we could do a big Roth conversion and lower our estate by doing the Roth conversion, and then we wouldn't have to pay those estate taxes, and then our kids would inherit Roths, where they could pull out tax free. So estate taxes are, if we get into that situation. The only other thing I would add is one of the things we plan for in Pennsylvania, and most of our clients don't have estate problems, but they do have a transfer tax in Pennsylvania. When you die, you have a 4.5% transfer tax to direct linear descendants, and 12% to siblings, and 15% to others. And we had a situation where someone was in a partnership for 30 years, but they weren't married, and they didn't realize that the one person had a couple $1 million, and they ended up spending 15% state inheritance tax. So that's another tax to think about. But we do appreciate our clients. Thank you for being with such a loyal group of clients, and thank you for your many referrals. We're going to post this seminar onto the website shortly, and you can recommend to your friends. Contact us if they have any questions. We do initial consultation and even a full financial plan for them without a charge, without any strings. If it makes sense, we can implement it. So it's real. We've been able to help. We have almost 1,000 clients now. And we have capacity. We have a team of 25. Look at the website and just say happy holidays, happy Thanksgiving, and happy New Year for all of you.